Okay, everyone, let's go ahead and get started here. Yeah, we're doing it at an odd hour today. We've just been very busy behind the scenes, and hopefully get back on a regular cadence soon. So hopefully this volatility isn't a shock to everyone here. I've been warning about this really for some time now. We went from maybe 3% cash to about 25% cash. We're currently just under 20%. And we have a handful of momentum stocks, which I'll get into, momentum plays, including Bitcoin. And if we start seeing three-wave bounces, then you'll see us get out of those. And so we'll probably be in about 25-ish, 26% cash. And we've been rebalancing, so rebalancing into stronger stocks, stocks that both technically, fundamentally, and from a product positioning standpoint appear to be in secular uptrends, long-term uptrends. It doesn't mean you won't see big drawdowns. Like take app, for example. We'll get into that as well. From my count, app is in a fourth wave within a larger uptrend. And so it's up to everyone here to understand, like when you look at these charts and look at these levels, how much risk do you want to take? Can you handle? Because we're seeing these secular uptrends in a lot of stocks that we're focusing on, doesn't mean that the corrective pullbacks in those big secular uptrends won't be painful to deal with. So anyway, let's just start out. We're just going to start out. I'm going to kind of continue to build the case that I've been building pretty much every single week. And we're going to start with the cycles. So we've been following the 19, very strange. There's only two periods in 125 years where we saw a 2-month bear market. And within 6 months of the top, we're double digits higher. And that was in 1980, 45 years ago, in 1998, 1999, which was about 26 years ago. Interestingly, both of those cycles, 45 and 26 years, line up with Gann cycles we want to focus on. And the market has been following them pretty closely. It broke the 45-year cycle. So we've been following the 26-year one, which says we should see some kind of move higher into February, mid-February. I'll get into that. This is all very, this is just kind of a roadmap in my opinion. But once these cycles start breaking, what that means, it's another one of these bigger cycles is now taking the lead. What I did down here is I took all major cycles that I like to follow. I'll follow the 7-year and 10-year, but I'm talking about like the big ones. There's a 90-year as well. However, the S&P hasn't been around for 90 years, so that goes into the Dow. But these are the major ones, the 60-year being probably the most important, the 20-year as well. When you do a composite of all of these and weight them out, it's saying we'll see some kind of high in late March, maybe early April, and then this. This is a big drop, right? Volatility, and I'm expecting a pretty large amount of volatility in 2026. What I find intriguing is that this is telling us that late September, October is some kind of major inflection point. According to this composite cycle, it would be some kind of a low. If we look at like our cycles, the big cycles right here, this kind of bright green one is my favorite cycle. It is it's batting perfect. Every time it shows up, something pretty dramatic happens. In fact, this is one of the main reasons why we were so incredibly defensive in early 2025. It's showing up again in September, October, along with a very rare and very important cycle as well. So I've been identifying October for some time. The composite we're looking at is as well. And so we're just going to have to see what plays out. If supports start breaking in a meaningful way, then we scrap this, move higher into February, and we're looking at something down here. We're looking at one of these that's going to be taking place, which we'll figure out in real time. However, going back to our kind of our windows, if you're new to this kind of cycle work, this is Gann. He was the master of cycles. It's one of the weirdest parts of technical analysis and one of the more accurate parts too, which is, it's not my primary source. Price to me always dictate price and patterns that are in play are my number one. but I use this information as kind of an addendum, just kind of like a backup. When I see price and time come together in a meaningful way, then we're talking about something pretty meaningful, usually, and it's a very early warning. So when these cycles, what matters is, how are you trending into them? And you'll notice the trend tends to reverse going into all these cycles, right? Sometimes you'll get like a breakout move. That's more rare. That's probably like 25% of the time. But mostly what matters is how are you trending into these cycles? When they cluster is when it really matters to me. Cluster here in February. Um, and the next cluster is coming up here right now in February again in 2026. Also, you'll notice this red line. It's a 45-degree angle, and this is a different angle from a different major point. Is also crossing. When these angles cross, it tends to be a big deal as well. And that's coming in at about 7,100. So we see a move in S&P up to 7,100 in sometime in the next week, couple weeks. And these divergences, what I'm going to get into, build even more, then we have very strong sign that this thing's about to unravel in a meaningful way. Okay, so that is that portion of the cycle work, the weird technical analysis work that I do, is warning that 2026 will be volatile, which I've been saying for some time. Now we get into positioning. This usually shocks a lot of people. It shouldn't anyone here unless you're new. But I talk about it every week. The AAII, this is what retail investors, has how they feel about the markets. You know, are you bullish 6 months out? Are you bearish 6 months out? What's the spread between the two? Who cares how you feel? What are you doing? How much cash do you have? What's your stock allocation? Okay. Um, and what's shocking to me is this level of cash and exposure to stocks. It's very rare to see this. In fact, I went back through every single major top going back when these surveys were around. And I mean, the only other time in cash that beat this was 2020. But in terms of stocks, I mean, we've been at like 90, the 94, 92 percentile. You have to go back really to 1998, 1999, which was one of the most exuberant periods in market history to see this level of retail excitement with stocks and no cash at all. This right here is a survey asking professional money managers what they're doing. Stock exposure, 84% stock. Last week, 92%, 88%. This is percentile readings. So I look at all the readings for the week and it rates them as percentiles. This reading right here in January 1 was the 94th percentile of all readings we've ever seen. And what gets me is how long this has been going on. I mean, even professional money managers are all in on stocks and have been for a very, very long time. And just to make it even more concerning, if we look at retail investors, not all retail, but this is kind of a good gauge of retail. This is margin accounts at brokerages. And I remember in early 2025, we hadn't broken out to a new high. Typically, when you see big volatile moves, that was a big volatile move, but it was a quick one, right? I'm talking about more prolonged, volatile, painful periods. Usually, margin will break out to all-time highs. Due to exuberance and sentiment. And so not only is retail, they have no cash, they're all in on stocks, but they're borrowing hand over fist to buy those stocks at these highs. And anyone that's messed around margin knows that as exciting and awesome as it on the way up, it can ruin you on the way down. The forced liquidations to meet margin calls. You just blink and all of a sudden your portfolio is cut in half. And that's is typically what happens. What this tells me is that, if and when retail is wrong about this, uh, when supports start breaking, it will probably be a pretty dramatic move. So all of this is telling me not good, not good. Building on this, I like to focus on divergences. It's a big part of my system. Whenever we see all markets moving in the same direction, that's a powerful trend. Financial conditions, which is really a crude measure of liquidity in the markets, economic liquidity, not stock liquidity. It's topped here in January of 2025. Markets have been moving up regardless. High beta, significantly. This is clearly a top. And I'll get into that later. It topped here in October. The Mag 7 equally weighted has topped as well in late October. I'll get into this a little deeper. Financials topped here in January. This is put in the top as well. Small caps also topped in late January. And then the inverted VIX, which is, yeah, not as important, but all these major markets right here put in the top. We're going to get into the equal weight Mag 7 because this identifies periods where the Mag 7 equal weighted does not make a new high, but the S&P does. It's got nearly a perfect track record. Pretty severe volatility. Sometimes it's sharp and quick, but at least identifying periods of volatility. This is the longest divergence that I could find. In fact, the divergences we're seeing in the market right now are some of the most extreme on record, and that's not good. And so we'll kind of dive into this a little bit deeper. This is the Mag 7. The only one of the Mag 7 that's making a new high with the S&P recently was Google. Microsoft topped in July. Meta topped in August. Nvidia and Amazon topped in late October. Apple topped in December, and late December Tesla. This is a good example of how markets will kind of fall like dominoes, right? They don't top at the same time. And you could be looking at this and saying, oh, well, that's probably good news, right? We're seeing a broadening out. We're seeing breadth expand. It is a big deal, and this is why it's a big deal. This is the S&P 500, and these are the weightings right here. So if you count up all the weightings minus Google of your Mag 7, I'm going to include Broadcom because it topped as well, I believe, or it's very close to confirming it. You're looking at 28% of the entire index. Okay, so let's say there is a broadening out to more value names. Then let's say Procter and Gamble, Bank of America, Home Depot. We'll include ABVI, Costco, Mastercard, Visa, Walmart, Johnson and Johnson. All of those together maybe account for what Nvidia does. You see what I mean? So this is a gigantic weight around the neck of any continuing uptrend. This matters a lot. I don't care if we're broadening out or not. If the Mag 7, considering how much weight they hold in these indexes, does not continue higher, eventually the broad market will follow the Mag 7 down. I hope that made sense. Okay, and look at some of these names. Microsoft. My goodness. I've talked about this before. From the April low, 1, 2, 3. There's your vertical 3, right? Volume expands, momentum does. There's 4. And look at this fifth wave. It did not make a new high above 3. It's called a truncated fifth wave. They're extremely rare. I've been talking about this in real time. And what I've said is if it's a truncated fifth wave, the reversal is going to be epic. And it's going to kind of rip your face off a little bit. And that's what we've seen in God, just like 3 or 4 months. We're down 30%. We closed the gap from April. Just brutal price action. And a phenomenal company too. Apple, we got 3 waves off the low. Volume is expanding, which is encouraging. But look at how high momentum is. We're probably going to see some kind of a drop and then maybe one more move higher. At best, it's going to be a fifth wave. So it'll be the final little swing in an uptrend. Amazon, I'm starting to believe this gap lower right here is confirming that we've topped. The only move higher is some kind of weird diagonal pattern that will have to take you out to like May or July. I just have a hard time seeing that happening. So Amazon likely is put in the top. People don't want to hear this, but Nvidia broke 176. That's not good. Below 170.31. And that's put in some kind of a top. And I think that you'll probably see us go down to 135, 116 over time. It'll set up phenomenal buying opportunities, but this is just not constructive right here. Avgo 2, we have 5 waves off the April low, and now we're comfortably below the supply zone right here in red. It's hard to see, it's hard to say this is a fourth wave. I'll give it potentially the benefit of the doubt, but if the next move off the low is some overlapping 3 wave move, then it's confirming a top as well. And it's not just the Mag 7. Like we talked about financials. Take a look at ARC high beta. There's 5 waves up. I was hoping this would be a 4, but this move right here was just too overlapping, and now it's just waterfall down. So maybe we got a few more squiggles, but we should get a three-wave bounce soon that'll make a lower high. Financials too. This is a big one. You know, five waves off the April low. This drop is too deep to be a part of a continuing uptrend. And financials aren't high beta and they're not Bitcoin, right? Is it an extreme risk asset? It's kind of in the value category and it's confirming a top based off how deep this is. This isn't good. It's telling us we're on borrowed time for any kind of uptrend, which is why I'm hesitant that we'd see some kind of uptrend into like, you know, late April, May. Anyway, moving on, consumer discretionary, I believe confirmed the top of this gap lower. That's one, two, three. It's probably a third wave. Maybe we get a bounce and one more drop, and then we get a bigger bounce. We have five waves off the low, and now we're gapping lower. Not ideal. So, like I said, it's not just the stocks, it's the sectors that are dropping like dominoes. Um, One of the reasons that we started raising cash. So, anyway, and it's not just it's international as well. The German DAX, I was saying down here, we need a fifth wave higher. We got to move higher. We got that fifth wave. This to me looks like a fourth wave, and we should get one more move higher, but that's it. If we start trending below here, then that means this right here is a low, or it's a high. We've already put in a high. The Canadian TSX, I mean, look at that. Just gnarly drop on heavy volume right at a major high. The RSI is below the kind of extreme bullish sentiment, momentum play, and we'll probably get one more bounce back into this zone and then turn lower. But we were calling this out like this. Whenever you see the composite index make three lower highs and the price index makes three higher highs, that's a very strong sell signal. So anyway, why we could continue to bounce, just to kind of give you an idea. Let's go back to here. Where are we at? So these are my divergences. Look at what's breaking out. The advanced decline line broke out to new highs on February 4th. This is a really good indicator on the S&P following. Sometimes it takes a little time, but it tends to follow. Transport's breaking out to new highs on February 2nd. Like, what's that all about? High quality value breaking out to new highs. I mean, the Dow's holding up really well right now and pushing higher. And if we look at positioning, for example, like where's money going? This is just from the beginning of the year. Blue is defensive. This is kind of your reflation trade, and oops, this is risk on and green. And here's the S&P. So above here means this is what's going. This is what's getting where money's going. And you can see a broadening out of transportation, industrial, small caps, Google, Meta, retail sales, biotech. I mean, I wasn't seeing this in early 2025. We saw consumer staples, utilities. If you remember, I was talking about this regularly. The dollar was catching a bid as well. So we are seeing some of these defensive trades make a move. I wouldn't consider gold defensive anymore. I'll have to change that. But consumer staples, is now outperforming these right here. I mean, your risk ons, utilities is starting to creep up. I consider Apple defensive, and the reason why is because if you're managing billions and you need to stay in the market and get out quickly, it's a very liquid trade to do. But we're starting to see defensive move up a little bit. I would like to see these green ones push lower and these push higher, but we're not quite seeing that yet. The other reason why I think that we could continue higher is the market internals aren't really, I mean, they're getting weaker, but it's not like kind of in a very, very dangerous situation yet. Oh, this just turned. Realized volatility just turned into a high volatility regime. So that is a knock on the internals a little bit, but the options market's still hanging in there. We're not seeing the skew really break down, or excuse me, push higher. If today, whenever this index closes and recalculates, if it moves lower, that means that deep out of the money puts are being closed, that defensive puts are not really wanted. That tends to favor some kind of a push higher. Breadth is hanging in there, momentum's hanging in there. Let's see how this closes. If this realized volatility triggers a risk off regime, that's a little bit more of a big deal. But we still got a little bit time before the market closes.